Welcome. It is Saturday morning for Albuquerque Real Estate Talk. That's the Tigo Venturi, usually with Tigo and Tracy Venturi from the Venturi Group of Real Broker. If you want to reach us, we're at 505-448-8888, and our website's welcomehomeabq.com. If you're joining us live on YouTube or Facebook, click like, say thank you, or say I'm here, whatever it is. But in the craziness, kind of in the financial markets, I guess the best way to put it, there's been a lot of news about banking. There's been a lot of news from the Fed and what they're doing with the prime rate. And so I brought in two mortgage experts today to talk mortgages. So we're going to take a deep dive on mortgages. We have Chris Krupar with got them mixed up. Chris Krupar with Bay Equity Mortgage and Joanna Rushing with Primary Residential Mortgage, both local lenders. And if you guys listen to, anybody that's listened to our show, Tracy and I always say, use local lenders because, we always say, and I'll say it for you guys, it's like, you guys have a reputation to protect within the community and you guys get things done. You really want to make sure, that the people here are taken care of, the buyers and the realtors, I hope. Anyway, so Chris, just introduce yourself and how to get a hold of you and your MLS number.
I'm Chris Krupar with Bay Equity Home Loans. To reach me, you can reach me at 505-379-9079. My NMLS number is 1395501.
And Joanna, same thing.
Awesome. I'm Joanna Rushing, and I'm with Primary Residential Mortgage. And the easiest way to reach me is on my cell phone at 505-917-6102. You can call, text, whatever's easiest for you. And my NMLS number is 1427054.
Awesome. So my first question for both of you, Joanna, we'll start with you, is do you see the stuff going on in the banking world, the I'm going to say air quote, banking crisis that's going on right now? Mm-hmm. Do you see that trickling into mortgages and mortgage rates right now?
Indirectly, yes. So I think it's important to realize that the banking crisis is, it's really kind of hard to describe the correlation between the two, because mortgage rates are going to be influenced by the things that are going on in the economy and going on in banking sectors, and then also influenced by what the Fed's doing. And it's a pretty complicated web. But at the end of the day, what's bad for the economy is typically good for interest rates. Not always, but typically. The problem is that it's a fine line. When the economy gets too bad, then that can take things too much. And so I think right now, with some banks melting down, that is putting some pressure on the Fed to maybe pause some of their interest rate hikes that they were planning to do and not be quite as aggressive as they were planning to do. And when they do that, that actually is good for mortgage rates, because they're being a little bit less aggressive with their fight against inflation because it's starting to work. And they're starting to realize that if they go too aggressive, then it's going to have kind of unexpected consequences like big bank meltdowns. Yeah. Now, as far as like the mortgage bank that I work for, all we do is mortgages. So we don't have, a danger of everybody pulling out all their assets from what we do. So there's no danger there as far as mortgage bankers are concerned. But again, there's an indirect correlation where if the whole banking industry were to melt kind of all at once, well, yeah, we'd have a big problem. The Fed's doing everything they possibly can to make sure that that doesn't happen and keeps mortgages at least afloat. That's
great. And Chris, I'm assuming you concur with just about everything she said. Do you want to add more thoughts on that with the banking? And also, I don't know if you can go into this as why these banks are having liquidity problems. Do you want to tackle that one?
So some of the liquidity issues are really just in that, where they have what their portfolio investments look like. And so with inflation being what it is, some of these banks are, decided to go into investments, very high risk investments, and unfortunately those investments didn't produce, right? I mean, that's the problem with high risk. That's why some folks pay a financial planner and pick the easy button investments where they're not going to make a lot of money, but it's going to be consistent over time. And so banks and this ties into the whole federal, the Fed's fund rate, which is, that's often confused as the mortgage rates, right? When people say the Fed's hiked the rate by a quarter, folks do think that mortgage rates went up by a quarter, but that is the overnight bank-to-bank lending interest rate. And so when banks are in the process of moving money, even in overnight investments, overnight exchanges, as those rates continue to go up, then that has sort of a trickle-down effect on everything that's tied to the banking industry. And that can also impact, a bank's liquidity, their ability to move money. Everything changes. One of the things that folks may not realize that happened early on in the pandemic, when the pandemic hit the United States and we started seeing cases developed here. I don't know, who all recalls that the stock market, tanked on a particular day. And for one of the first times ever, mortgage-backed securities, which determine interest rates, they tanked on the same day. But they had been building up. Rates had been getting lower and lower and lower. And we woke up on a Monday morning in the middle of March, and everything had shifted substantially. And it caused and I'm really, using layman's terms here, but it caused a log jam. And that log jam wasn't just for mortgage banks. Banks like Wells and Bank of America, they have mortgages, they're depository banks, and those funds are all part of their investment portfolios. And so, it was a significant logjam effect. And that is something that the Fed has to be focused on at this point in time. When we talk about the potential of banks failing or people panicking and pulling their money out, how much further are the Feds going to drive these overnight bank-to-bank Fed rates? What they do need to focus on is that they don't cause those log jams, that they allow for there to be liquidity. The Fed solution back in March of 2020 to increase liquidity is they then themselves became the biggest purchasers of mortgage-backed securities so that they could drive their views up and interest.
And I think, in fact, I remember talking to Mon at the time, who Joanna works with, and he's like, we were close to the brink, like the mortgage market, like, I think I talked to you about it at the time too, Chris, where it's just like, it was dicey there, where like basically there was going to be no mortgage money because nobody wanted mortgage-backed securities. So Joanna, let me jump to you. Mortgage-backed securities, we hear that term. And anybody that watched like the movie The Big Short, right? And what happened in 2008, they hear mortgage-backed securities and their hair in the back of their neck stands up because, there was all that crazy stuff going on with those. But just what is a mortgage-backed security, and how is it tied to mortgages? Does that make sense? Is that
Yeah, let me see if I can make it pretty simple, because at the end of the day, it's a very high level concept, right?
Right.
So I think the easiest way to think about it is that we, as a mortgage lender, we are borrowing money on our warehouse lines, and we put a markup on it, just like Walmart buys 5,000 toothbrushes and then they put a markup on it and sell it to you for more than they paid for it, because you're not going to buy 5,000 toothbrushes, right? We are, not you. And we package them down into smaller chunks, hundreds of thousands of dollars, lend them to you as the consumer, and you get it at a certain interest rate. Well, then in order to keep our liquidity going, we take those same loans that we've already sold and we package them all back up after we've sold them into basically what ends up becoming a mortgage-backed security on the secondary market. But we take all those, loans that are all at 5.5% or whatever, package them up and then sell them as a whole on the secondary market to an investor. And that investor will buy that, and those are what is the basis for a mortgage-backed security. So it's going to be an investment that you can buy into, but it's going to be multiple people buying into that investment, because you're not going to buy millions and millions of dollars by yourself. It's going to be packaged up, and then those 30-year mortgage loans that are all at 5% from God knows where, all across the world, or not world, all across the U.S., are going to then be the basis of your investment. And so I think that's probably I don't know, Chris, if you want to maybe.
No, that was great, Chris. I don't know. Do you want to jump in on that? Any other thought?
Yeah, it's my mortgage and your mortgage and a whole bunch of mortgages, maybe $100 million worth of mortgages, all with similar interest rates and all the similar risk factor bundled into an investment commodity. And so we end up with this tiered system in the U.S., which, based on somebody's perception of that, it could seem like we have an awfully complicated system with a lot of people, having their fingers in it. But that actually is what allows us to be one of the few places in the world that you can get a 30-year mortgage at an interest rate less than 12%, right? And to where that your mortgage is going to be the same or less sometimes than renting somewhere, which we all know the rent is 100% interest. And so the fact that it is this multi-tiered investment commodity, that all of our mortgages could be bundled together and then other folks can invest and make money off of that long-term interest, is what really allows us to offer what we offer to the consumers. So it is in itself sort of a protection. If all loans were just individual banks going back to their vault and handing you their money, the risk involved in that and failures at banks would trickle down. And this way it creates investment opportunities and protections under the umbrella.
Yeah, there's definitely a level of insulation. And going back to, the mortgage meltdown and the Big Short, I think what's really important to understand is that because that happened, many more safeguards were put in place so that it doesn't happen again. And so, it used to be that you had a pulse, you could get a mortgage, and that's certainly not the case anymore. We put our clients oftentimes through what they feel like is the ringer. I had somebody call it a financial colonoscopy one time, and I thought, well, that's accurate. Not maybe the best analogy, but accurate. And the idea is that we make sure that those mortgage-backed securities then that we are selling on the secondary market and that we are funding and that we are creating out of the loans that we originate are going to be much more sound investments, because we've vetted the buyers and the borrowers that are making up those giant pools of mortgages to make sure that, like Chris said, they're all similar risk factors and the risk factor is relatively low. That's why we're looking at ability to repay and all that kind of stuff, making sure that you can make good on that investment and that what we're selling really is viable.
Well, I want to pull that string about, just go down that road about, qualifying. But unlike 2006, where, today you actually have to prove that you can actually pay for the home, which, let's be honest, that was not happening in many cases back in the day. So people that are concerned about that same type of meltdown that we had back then, it's not going to happen post Dodd-Frank, right? It's a very different world, very different markets than we had back then. But Joanna, I just go with you real quick here, and then I'll jump to you, Chris. Let's just talk about what is the qualification process, if you will, just real high level. If somebody wants to get a mortgage, what do they expect they're going to have to deal with?
The way I usually break it down for my clients, especially my first-time home buyers, because I deal with a lot of first-time home buyers, is that we look at three main things. We look at your credit, which is your credit score, what you owe people, how often you pay them back, all that's kind of be wrapped in your credit score. But we look at your credit. We look at your assets, which is just a fancy word for how much money do you have in the bank available for this transaction. And then we look at your income. And your income is going to be gross income. Usually we're concerned about the monthly amount you bring in before taxes. But we're also concerned about how stable is that? How long have you been at your job? Do your hours fluctuate? Are you salaried? Is your income likely to continue? All those things. But really the way those three pieces fit together, credit, income, assets, that's going to determine what kind of loans programs you would qualify for, and also what kind of terms you would qualify for within those loans. But the qualification process is basically, again, like I said, the ability to repay. We're going to look at your credit, income, and assets, those three factors, to figure out if we can reasonably expect you to repay the loan. And a lot of people are like, whoa, I don't know why it's got to be that hard. And then when you kind of think about it, you think, well, you want hundreds of thousands of dollars, and we're expecting you to make a 30-year commitment to pay us back. And when you kind of think of it in those terms, all of a sudden, maybe it's not quite so crazy what we're asking for. But once we ask you for those things, the name of the game at that point is to check, double check, and then check again. So you say you make $50,000, and that's great. You probably do, because most people aren't liars in my experience. But it may be that now you need to provide your pay stub. And so now your pay stub confirms that you also make $50,000. And then I'm going to go to your employer and I'm going to say,
we actually have to prove that we make that much money? Again, back to 2006, it was not that way in 2006, I'm afraid.
Nope. But that's why 2006 isn't going to happen again. 2007 and 2008, that's not going to happen again, because the entire system got not a facelift, but like a whole makeover. It's completely different.
So I think, Joanna, you answered that great. So Chris, let me just ask a different question on that. So she talked about your income, your debt to income ratio, your credit score. I know this is a complicated conversation, but how do those things affect the mortgage rate you end up getting?
So, for a while, the actual interest rates that were offered to a particular borrower were almost entirely driven by the credit score. A lot of the other indicators went quiet for a while, and we could pretty much know that if somebody had a 740 credit score and they were going conventional, we would have a pretty good idea of what that rate was going to be. But other indicators have crept back in, made their way back in, and even more recently, Fannie Mae, Freddie Mac under FHFA changed what we call loan level pricing adjustments. And so now when we get a full application, and this is what's really important, folks will say, why do I have to apply to get an interest rate? And it's like, well, because there are a lot of indicators, and until we can look at the whole story, we're really guessing. And none of us ever want to be in that position of making somebody feel like we've provided for them some sort of a bait and switch scenario where we mention a rate out loud, and then we get an application, come to find out that everything is far different than what we had in a verbal conversation. So along those lines, credit score is still significant. 740 is that interest rate that you want to hit to have the best impact from your interest rate. And then every 5-10 points or so that you go down, things are adjusting on those interest rates. But now we're looking to see who's that debt versus income ratio. If those are higher, particularly if they're over 45%, if your new house payment and the debt shown on your credit report are taking up as at least as much as 45% of your monthly income, then there's going to be another adjustment. And the way that they've done this now, the way that they've built this thing out, is that all these things and all these factors that are adjusting interest rates are actually now favoring people who would have had a little bit more of a difficult time getting the loan, meaning somebody who doesn't have as much to put down, somebody who, though they don't qualify for a particular first-time buyer program, if they are just a first-time buyer in general, and if their income is at a certain percentage of the area median income, then the adjustment to that rate is in their favor. And so while it felt so complicated, it looked like rates were getting more difficult or going higher because of this new way of calculating them, it's actually benefiting the folks who've had more difficulties. Things have remained pretty much status quo for your government loans, VA, FHA, USDA, but conventional under Fannie and Freddie, we're now looking at a lot of different factors to come up with that interest rate. And I'll just say this real quick. The whole idea when somebody will call us and say, and I know, Joanna, you've had this, somebody will call and say, what's your rate? It's like, do you mean mine personally? Like if you want me to loan money out of my wallet, my rate?
Yeah.
All lenders, PRMI, Bay Equity, whoever you're talking to on any given day, when we have somebody's application and I know their debt to income ratio, their credit score, whether or not they're the first time buyer, if they, all those factors in play, then we look at a list of rates. And there's going to be a list of various rates for conventional and FHA and VA. And what it is it's a list from the absolute lowest rate available to the highest. And as you look at the lowest, there's a very low interest rate available, but it has a very high amount of what we call points. I think people have heard the term points, that you're literally paying money to get a lower interest rate. So if somebody offered you a rate, say, crazy low, like 4%, it might be 7 points, right? It's going to cost thousands and thousands of dollars. But we come down that scale and we go higher and higher in the available interest rates for that day. And we're looking for the one that has little or no cost for it. Sometimes folks refer to that as the par rate. And that's really becomes the rate. And the way that we work with our borrowers is to say, look, today, if you want the best rate that I could give you that really isn't going to cost you many points at all or any points at all, this is where we're going to start. Now let's talk about your comfort level if you actually want to spend some money, if you want to pay points to get a lower rate. And then we're going to talk about, does that make sense? How long are you going to keep this home? How long are you going to stay in the loan? But so when we talk about rates going up, my rate went up because my score got lower. It's that point cost. So let's just pick a number. Let's say that today somebody's interest rate was 7% and that cost for that rate was $300, right? If they had a 740 credit score. Well, if they have a 705 credit score, maybe instead of a $300 cost, it's a $500 cost. And eventually that rate gets so expensive that paying for it doesn't make sense anymore. That's what it really means when a rate is adjusted higher. It's the cost of a particular interest rate.
Yeah, got it. Well, interest rates, Joanna, let's talk about interest rates. So today, I follow MBS Highway. I follow Mortgage News Daily. They always put out a survey, and we were, beginning of 20. I can't even. It's so hard to even say because it just doesn't make any sense. At the beginning of 2022, we were somewhere mid threes, right?
Yeah.
By the end of 2022, we had gone over 7%.
Yep.
Now we came back down. We got almost a 6 here not too long ago. Now, and understand mortgage rates, they're national. Is there any regional fluctuation in mortgage rates, Joanna?
There's
Do you
a
ever see
little
that?
bit of regional fluctuation, not a ton, but that's probably even harder to explain. But yes, there is some.
Yeah.
Regional.
Okay. We won't go there. No. So anyway, so today, as we're talking, I think we're somewhere in the mid sixes. I think, for the best rate. What's the difference when we talk about programs? We've got FHA, we've got conventional, right? Those are kind of the two big things. And then we've got jumbos and stuff. I mean, how much difference is there in rates between these different type of programs?
Again, going back to what Chris was saying, it depends pretty heavily on the person and their financial situation. Again, going back to how their credit, income, assets all fit together. Once you fit those three things together, that gives you a much better idea of what you're going to be looking at. But the same borrower, apples to apples, the same borrower with a good credit score, mid to high 700s, well, you're probably going to be looking at a rate for conventional with the same down payment, let's call it 5%, is probably going to be a little bit higher than what I could offer them on an FHA loan. But that FHA loan is probably going to have higher mortgage insurance. It's also going to have the upfront mortgage insurance premium, which is going to increase their loan amount and is going to increase their costs. So it may be that conventional sometimes has a higher interest rate than FHA, but that doesn't necessarily equate to a better loan or a worse loan or a higher monthly payment. Sometimes it can be that monthly payment, even with a slightly higher interest rate, is better for that borrower for a handful of other factors. And this is why it's really important to work with a mortgage loan officer who, one, knows what they're doing, also knows what the market is, and I would argue is local. Because what we're going to do is I'm going to ask you about your credit, income, and assets. I'm going to ask you about your financial situation. I'm going to get your loan application in, and then I know my 300 products or 300 plus or whatever it is. And then I'm going to help you navigate through that because you don't know my 300 products and there's absolutely no reason for you to know my 300 products. Well, but because this is what I do every single day, I can look at it and I can say, okay, great. We can toss out these 295 products because those don't make any sense for you. But maybe these 1, 2, 3, 4, 5, most people don't go above 4 or 5 loan programs, but maybe these are the ones that make sense. And sometimes for people, it's like, you have one option and it's this. And if you want to do it, if you want to buy a house, we're going to do it this way, or you're not going to buy a house. And then there's others where it's going to be, this might make sense, or maybe this makes sense, or if you adjusted this here, that would actually make more sense. And then we walk them through it. But the difference between those rates can be pretty drastic. And that's one of the things that we look at that helps indicate whether or not a buyer should be in a conventional loan or an FHA loan, or maybe with some down payment assistance or a bond loan or whatever the case may be. A good way to look at it is for a first-time home buyer, maybe who has a higher debt-to-income ratio, a lower credit score, maybe a little bit less money in the bank. Well, a conventional loan for them is going to be crazy expensive because if you don't have a credit score up there where conventional is going to kind of work for you, then an FHA loan is a much better option. And then usually what I tell people is, great, now you've bought the house, let the equity work for you, save some more money, work on your credit, and in a few years, let's refinance you into a conventional loan. We can get rid of your mortgage insurance, probably drop your rate. Like, we can make your situation a whole lot better. And we can make use of the fact that you've owned that property for 5 years and gotten all of that equity in the meantime. So it's not cut and dry. And like Chris was saying, we have people all the time who say, what's your rate? And I'm like, what do you want it to be? Let's talk about it.
Yeah.
I mean, there's a million ways to answer.
I argue myself as a 10, right?
Yeah. And when you say 300 products, I think people are like, what? 300 products. There's not just one mortgage. It's like, no, there's not just one mortgage. There's 300 or more products out there in that world. Chris, let's talk about mortgage insurance a little bit.
Well, first, I'm jealous. I think I only have like 298 products. So.
Oh, got it.
I'll take the other two.
Yeah.
All right. So mortgage insurance. I know that a lot of folks love to talk about mortgage insurance, and there's often a little bit of confusion there. I've had folks ask, well, if I have mortgage insurance and I pass away, does it pay off my house? Well, no, it does not. So mortgage insurance in general, it is insurance that somebody pays depending on their loan scenario that actually protects the investment bank that's going to hold that mortgage for 30 years in case of a default. So one way to avoid mortgage insurance is to go with a conventional loan and put 20% down. If you put 20% down, they feel like you've started into that with enough equity that you're lower risk, and so they waive mortgage insurance. VA, if you go with a VA loan, they do roll in a funding fee for different service members depending on first or second time use. It gets rolled into the loan amount, but there is no monthly mortgage insurance. And then ultimately FHA. Most folks think of FHA that of course they do roll in an amount up front into the loan for mortgage insurance, and you pay a monthly mortgage amount. Great news on that is for the first time in a very long time, FHA finally decided to admit that they had more assets than what they really needed, and they've lowered their mortgage insurance. So mortgage insurance has dropped a bit for FHA. And a little unknown thing that some folks don't realize is if you put 10% or more down on an FHA loan, and there are times when that makes sense, then that mortgage insurance is no longer for the life of the loan. It goes away at 11 years. So that's just a nice option, especially in a market when you know you're getting a really low interest rate and it may be forever until you refinance. Just knowing that you can get rid of that mortgage insurance helps. So back to conventional. Conventional, if you put less than 20% down, then you will have mortgage insurance. Depending on how much you put down, that amount that you're charged goes up. There's a different amount for, like, if you are a first-time buyer, some folks don't know this, you can go into a conventional loan if you meet the requirements for as little as 3% down. However, only putting 3% down, unless you are in a special program called Home Ready, then the mortgage insurance will be at the highest amount. And then when you put 5% down, it goes down a little, 10, and so forth and so on. Ultimately, most servicers, when they set you up, they want to see you pay that mortgage insurance for the first couple of years. And then after that, you pay that mortgage down to 78% of the original value, and you can have that mortgage insurance removed.
Yeah, that was my question on that is, we hear people say, well, you can, once you get to 20% equity, more or less, you can drop the mortgage insurance, but that's not automatic, correct?
It's structured to be aware that when you're at that mark, but you're gonna want to pick up the phone and call your loan servicer and say, hey, I'm looking at my amount here, and I would like to have my mortgage insurance removed.
Now you said 3 years. It does have to season for 3 years before you can.
Usually 2 years. Servicers want you to make that because they adjusted pricing accordingly when you went into that mortgage and you agreed to pay that mortgage insurance. Well, if you win the lottery or something happens and you decide to make one big lump sum payment, and you no longer owe 80% or more of the value of the home, they originally structured that anticipating that they were going to receive those mortgage insurance payments, at least for the first couple of years. So it's always a conversation that anybody can have with their particular loan servicer, that who's going to actually hold that loan for the long haul.
So let's just wrap this up with the I always call it the cloudy crystal ball. So what's your take on mortgage rates, Chris?
Wait, here's my crystal ball.
Yeah, bag of nuts. What's your thought? What do you think rates are going to do here? Now we're in what are we in? We're in March, just about to hit the quote buying season. As soon as school gets out, things generally pick up. What do you think we're going to see here over the next 6 months on mortgages?
It's funny that when you ask me, what am I predicting here? I just binge watched the old Rocky movies, and I remember when they asked Clubber Lang, Mr. T, what the prediction was for the fight, and he said pain.
Yeah. We've already had that.
Yeah. Yeah. I mean, when you look at it, going back to October of last year, mortgage-backed securities hit the lowest point that we had been at in a very long time. We were seeing rates, pushing the 8% mark. Things are, we're very high, especially if you're looking at second home or investment properties, but we have cooled off. I think the most significant factor in that cooling off is that inflation has cooled off. We saw that the Feds, going back to last summer, that was one of the first times where 2 to 3 significant Fed rate hikes actually helped interest rates, because what people have to remember, all investments begin with human beings, and human beings can be influenced, right? And even big companies are owned by human beings. And so all those human beings said, oh, somebody's finally admitting that inflation isn't transitory. They're actually going to do something about it. And so even though they raised that bank-to-bank overnight lending scenario, we had a wonderful increase in mortgage-backed securities because people actually felt like, oh my goodness, now we're doing something. And what's happened more of late, and what is helping us not see an immediate impact from these, banking failure situations, is that even though inflation continues to increase, it's increasing in a lower percentage than what predictions were put out, right? Once they realized that this inflation isn't transitory and they projected what it was going to look like, well, now we're doing a little better. To me, that means a couple of things. I know there was a while that folks were telling folks to hang on there, we're going to hit a recession and rates are going to be back down. And I hate to say some of the low numbers that people were throwing out there. I was never one of them. I was waiting to see what pumping the brakes on inflation was going to do ahead of any type of a recession. And so with that said, the likelihood of us seeing rates in the 3s and 4s again, that would take a hard landing, job layoff kind of recession that we don't want to hope for to get a lower interest rate.
Yeah, that would be ugly. If we got in an economy where we had to see those type of mortgage rates again, it would not be pretty.
I don't want to go back to being locked in my house for a year to get a rate that low.
Yeah.
I don't think anybody does. And all of those, when rates are below 4%, that's a sign of a sick economy. The economy is unhealthy. And congratulations to everyone who grabbed one of the low interest rates. But these rates where they're at now, I tell folks, we are back to where we were before 9/11, 2 Gulf Wars, a recession, and a pandemic, right? I mean, we're just back to those, 6s and 6 to 7% range where mortgages hung out for a very long time. But what I think that we're going to see, since inflation, though it's still on the rise, but is cooling, I think we'll go possibly more into a technical recession, a mathematical recession, maybe not a huge job layoff type, and maybe we'll see rates come down a percentage point. I think that maybe we'll see, if we're lucky, we'll see mid-5s. That would be wonderful. We could help a lot of folks refinance. But talking about 3s and 4s, I don't want to hope for what that would take, and I'm not seeing those indicators right now.
Yeah, no, thanks for that. And I'm kind of on the same page. I think you and I probably follow the same people though too. So, we might just have some little bit of a confirmation bias or whatever you want to call it there. But, one thing that jumped out at me, Joanna, is so the 10-year yield, right? We talk about the 10-year U.S. Treasury yield. And right now it got, it was almost zero at one point, right? That's when we were seeing those 3% mortgages. And now it's gone all the way up. It went up over 4. Now it's pulled back to about 3.5. But historically, and I heard this from Florence Hune, from the chief economist from the National Association of Realtors. Historically, there was always like a 1.75, or as we call it, 175 bips between the 10-year and what mortgage rates were doing. And today, so what is that? We're at 3.5 today. And if we do 1.7, that means if we follow that theory, mortgage rates should be in the mid-5s, not in the mid-6s. So there's this extra pricing in there that maybe could change. I don't know if you want to speak to that, Joanna, as well as what you think, where we're going with mortgage rates.
I think, honestly, Chris, I think you hit the nail on the head. I would agree with you. I think 3s are a thing of the past. 4s are probably going to take more than I want to go through to get to, and more than I think our economy really can kind of handle right now. Not that it would cause some sort of meltdown, but I don't think anybody is really jonesing for what that would take. 5s, I think, are realistic, and I'm telling people, I fully expect to refinance your loan in the next 1 to 3 years. I think that the markets are indicating that. I mean, that's one of the reasons why we're seeing much more points, is because servicers are saying, well, crap, all these rates are coming in these 6s and 7s, and no one's going to hold on to these loans for 30 years. So they're front loading it with points to say, we're not going to keep these on our books long enough for them to be profitable. And the only way we can buy them is if we front load them with some fees. And we need the servicers so that we can offer loans, and consumers need us so that they can get loans. And so that's a trickle down effect of those points. But I would agree with you that I think that as we see inflation start to cool, we're going to see interest rates start to come down as well. We've already seen some indication of that, right? So every time we get a lower inflation number than is what is expected, rates have a pretty good day for mortgages, and we have a lower interest rate for maybe a few days or a week, or maybe even just that afternoon. But really, I see rates going down, but not in this wonderful straight line that we would love. It's more like
Yeah.
all the way down.
And I think, would you both agree that going up anymore is not in the cards right now? Would you agree with that, Joanna?
That's difficult.
I know that's a dangerous.
I would agree. I don't think it is, but I think one of the reasons why that spread between the 10-year Treasury and mortgage rates right now is not necessarily what it should be historically, is because we've dealt with a lot of things that we haven't kind of been expecting coming down the pipe, namely the pandemic and the war in the Ukraine. Yeah. And I think those two things really threw a wrench in things. And so you have all the conventional wisdom that tells us, well, the spread should be this much and rates should look like this and mortgage-backed securities should look like that. And it's all well and good if no other factors are involved. But as soon as you put other factors in there that you weren't expecting, no one was expecting Putin to go invade the Ukraine, and now we're here. And so now we have to deal with that. And I think the Fed, this may be somewhat controversial, but I think the Fed kind of did the best that they could. And in doing so, they swung it way too far to one side. And now they're desperately trying to swing it back. And now we've swung too far to the other side now. So it's this pendulum that's sort of trying to find equilibrium. But there's so many external factors that we can't quite predict how that pendulum's going to swing with any sort of like real accuracy. So yes, I think we're headed on a downward trend. I think the downward trend is going to be a very jagged line. I don't think rates are going to go up, but I mean, the next crazy thing that we're not expecting could happen, and that could throw a wrench in the whole thing. But no, I would agree with you. I think we've seen the top. I think we're coming down. I think that realistically, we're going to be looking at rates in the 5s that will help a lot of people, probably in the next anywhere from 6 to 18, 24 months, somewhere in that range.
Yeah. No, I think. Yeah. Well, I think that whole idea that, mortgage rates aren't set in a vacuum. There's so many variables, right? And we could spend hours going, getting in the weeds on that. And in this whole idea, back to the top of the show where, okay, the Fed raises, the prime rate by a quarter point. How does that affect? And mortgage rates go down. It sounds counterintuitive, but that's just it. That's just one component of thousands of things that set the bond prices for mortgage-backed securities. So anyway, thank you guys. I thought it was a great conversation. I really appreciate your time and your expertise. Chris, first off, just again, your name, how to get a hold of you, if anybody's got questions about mortgages.
Again, my name is Chris. I'm with Bay Equity Home Loans. We're on the west side of Albuquerque. My cell phone is 505-379-9009. My NMLS number is 1395501. And I'm not just here to do home loans, but I'm here to answer questions. So all the things that we talked about today, if you've got questions spinning around, I'm here as a resource for you.
Awesome. Thanks. And Joanna?
I'm Joanna Rushing, and I'm with Primary Residential Mortgage. Easiest way to reach me is my cell phone, 505-917-6102. You can also check out my website at www.jrushingmortgage.com. And I agree with Chris. I'm here to be a resource. I have answered so many questions that people started off by saying, this might be a dumb question, and I will talk to you all day long about what may or may not be dumb questions. 10 years ago, when I started in this industry, I asked the question, what's a mortgage? So I'm pretty forgiving with questions.
Yeah. And I think people that are that don't do this every day like we do. They may be a little intimidated by the home purchase process. Obviously our side, the real estate, realtor side, and then the mortgage side is this whole other world. And it's like, and then you got this title insurance, and it's like, well, what the heck is that? So there are no dumb questions. We'd love to answer questions, right? All of us are customer service and servant oriented in the sense that we'd like to educate, right? I think all three of us are educators is our passion. And so we just love to talk this stuff. So anyway, thanks for tuning in. We're a Venturi Realty Group with Real Broker, and I am Tigo Venturi, usually with Tracy Venturi, but she's out of town at a real estate event, which is awesome. And you can reach us at our team at 505-448-8888. Thanks for tuning in. Take care.